I want to begin with the question that ruins more gold and silver investors than any market crash ever could. Not whether they were right, whether they could stay right long enough to get paid. That is the whole game. A lot of people think the hardest part of owning gold or silver is buying it in the first place. They imagine the test is courage at the beginning. Buy the metal, ignore the critics. Hold the line while the world gets stranger. They think that is the hard part. It is not. The hard part is much crueler. The hard part is watching the world give you every reason to believe the thesis should be working, and then watching the price do the opposite. Anyway, bombs are falling, oil is surging, the national debt is absurd, central banks are still buying gold in size, silver supply is already tight, and yet your screen is red. That is the moment when people lose the plot, not when the world looks calm, when the world looks like proof and the price still refuses to cooperate. That is the real test, because once the price stops flattering the story, most investors start asking the wrong question. They ask, what if the thesis is broken? The better question is much harder, much more profitable, and much less emotionally satisfying. What mechanism is overwhelming the thesis in the short run? And what always happens when that mechanism exhausts itself? That is the adult question. It is the only question worth asking here. If you do not understand the mechanism, you will sell at exactly the moment when the market is transferring future gains away from the confused and toward the patient. I have watched that sequence in one form or another all my life. Different decade, different war, different media language. Same human behavior. People buy the logic. Then the tape turns against them. Then they do not study the mechanism. They study their discomfort. And discomfort is a terrible analyst. What I want to do here is separate those things cleanly. Not because I enjoy sounding severe, because if you own gold, silver, or any form of precious metals exposure in a cycle like this, the difference between understanding the mechanism and merely loving the story is the difference between participating in the move and becoming part of somebody else's inventory. That is what this is really about. Not whether gold is good, not whether silver is undervalued. Whether you can correctly read the phase you are in, that is where the money lives. Now let me state the main line as simply as I can. Gold and silver are not failing because the long-term case broke. They are being temporarily overruled by a very specific short-term chain reaction. That chain reaction is not new. It has repeated after every major oil shock of the modern era. The oil shock raises inflation expectations. Higher inflation expectations keep the Federal Reserve from cutting. Higher or stickier rates keep bond yields elevated. Elevated bond yields make non-yielding metal less attractive in the short run. The same shock drives demand for dollars and dollar assets. A stronger dollar suppresses the dollar price of gold. At the same time, leverage money, paper market money, and rule-based institutional money begin selling because the arithmetic turned hostile. That is the suppression phase. And if you have never seen it before, it feels like betrayal. It feels like gold has failed its purpose. It feels like the rule book is broken. But the rule book is not broken. You are simply reading the wrong page. Gold is not rising during the war because the war is, at this stage, not just a fear event. It is an oil shock. And oil shocks do something very specific to the monetary and rate structure before they eventually do something else to the broader system. That distinction is everything. If you miss it, you sell in the wrong phase. If you understand it, the whole red screen changes meaning. Now, because this is where most people get lost, let me walk you through the sequence in the plainest language possible. A geopolitical rupture hits the energy system. Oil jumps hard, not because traders are bored and need excitement, because a real bottleneck appears in a real physical market that matters because oil is not one line item in the economy. Oil is embedded inside almost everything. Transport, food, packaging, chemicals, fertilizer, industrial production, basic logistics. When oil surges, the market immediately starts repricing future inflation, not measured inflation. Today, future inflation. That distinction matters because markets are not paid to wait politely for the government. Backward-looking reports to arrive, they move on expectations. Once future inflation expectations rise, the market starts concluding that the Federal Reserve cannot cut rates as quickly or as aggressively as it had hoped. That is the second step. And when the market believes the Fed will stay tighter for longer or cut later or maybe not cut at all for a while, long-end yields remain high or move higher. That is the third step. Now we are at the part most gold investors hate. A 10-year Treasury yielding above 4% is a competing asset, not a better civilization, not a better reserve asset. A competing asset. If you are an institution with a mandate and you can suddenly earn a material yield from a government bond with no storage cost and immediate liquidity, the short-run math changes. That does not mean you stop believing in gold forever. It means the next few months may reward a different parking place. At the same time, the same stress that is lifting yields is also lifting the dollar. Global money runs toward dollar assets in the early stress phase because dollar liquidity still sits at the center of the system. That is the fourth step. A stronger dollar means fewer dollars are needed to buy the same ounce of gold, all else equal. That suppresses the price in dollar terms. Now add the fifth step: paper market positioning, leveraged ETFs, futures, systematic money, institutional risk rules, margin calls. They do not care whether the world is fair. They do not care that your macro essay was elegant. They care about thresholds, opportunity cost, and the need to raise or reposition capital. That is when the price gets hit harder than ordinary investors think is logical. And that is why most ordinary investors fail here. They keep arguing from the big story while the tape is being bullied by the small-time arithmetic of the current phase. They think the big story should save them immediately. The market does not work that way. A correct long-term thesis can spend weeks or months being crushed by short-term mechanics before the big story regains control. That is not a contradiction. That is how real markets move. Now, I want to say something very clearly because it may save someone a lot of money. A red chart during a war is not proof that gold stopped being a safe asset. It is proof that the market's first response to an oil shock is not the final response. That is the line. The first response is suppression. The second response is recognition. The third response is structural repricing. And the investors who cannot emotionally survive the first response never get paid by the third. That is what I have seen over and over again. The question is not whether gold fell. The question is what always came after the fall. That is where history becomes useful, not as superstition, as pattern recognition. The 1970s taught the lesson brutally. When oil was weaponized and prices exploded, gold did not glide in a straight line upward from the first headline. It moved through suppression, confusion, forced repositioning, and then reassertion. And when it reasserted, it did so violently enough that the people who sold early spent the next phase watching a market they had been right about continue without them. That is always the double pain, the financial loss, and the psychological humiliation of hindsight. The 1979 cycle taught the same lesson in an even more dramatic way. Oil surged, fear spread. The monetary system lost credibility in layers. Gold did not merely rise because of safe haven demand. It rose because the system underneath the currency began losing the authority required to keep real rates meaningfully positive without breaking something else. That is always the deeper move. Not fear alone. A monetary system showing strain, gold and silver thrive, not merely on panic. They thrive on policy impotence. That is the real food. The Gulf War gave another variation of the same structure. Shock first, suppression mechanics, then reaccumulation once the market's immediate dollar and rate response ran its course. The dot-com period and the decade after 2001 offered another flavor. Gold did not have to win in a single week to win the era. That is something impatient people never understand. The most important trait of a cycle rarely announces itself by making you feel brilliant every Tuesday. Sometimes it announces itself by making you look foolish for a while in the exact window where the real edge is being transferred from weak hands to strong ones. Then 2022 gave yet another reminder. A great many investors thought the initial breakout through round numbers was the story. It was not. It was only the beginning of the market admitting that the paper system had become more political, more coercive, and less neutral than the textbooks pretended. That matters because a great reserve asset is not just something the public admires. It is something central banks move toward when they begin trusting the reserve architecture less. That is one reason central bank demand has mattered so much here, and it is also one reason the present suppression phase is so misunderstood. People look at the red screen and assume the strategic buyers must have left. What is happening is much more subtle. The strategic case is still there. The tactical mechanics are temporarily louder. That is all. Now let us talk about why 2026 is different, because this is where the story stops being a routine replay and becomes much more explosive. In the old cycles, debt was large but not grotesque. Now it is grotesque. In the old cycles, the Federal Reserve could theoretically force the system through an anti-inflation purge with punishing rates if it absolutely had to. Today, the debt arithmetic makes that much harder. Not morally harder, mathematically harder. That is a huge difference. A heavily indebted state can talk about discipline far more easily than it can live it. And markets know it. When the debt burden becomes large enough, every future point of interest expense is not merely a policy lever. It is a bill, a big bill, a politically sensitive bill, a bill that competes with everything else the government wants to spend on this. Matters because it means the old Volcker fantasy cannot be imported into the current cycle as casually as people think. Yes. The central bank can tighten, yes, it can speak harshly, yes, it can try to preserve anti-inflation credibility. But the cost of taking rates truly punitive in a world of immense debt is not the same cost the country faced decades ago. That is one reason I think the eventual repricing in gold could be larger than in previous comparable episodes. The suppressive mechanism is still there. The long-term release valve is weaker. That combination matters. Then there is central bank buying. This is not a minor detail. It is one of the deepest structural supports under the entire story. We are not dealing with a world where central banks are indifferent and private speculators alone are moving the market. We are dealing with a world in which official buyers have already been accumulating at elevated rates because they see what ordinary investors still struggle to say. Clearly, the dollar system is not being abandoned overnight, but it is no longer trusted in the clean, apolitical, post-Cold War way it once was. That changes reserve behavior if an asset class has central banks quietly accumulating through weakness while the public is being shaken out by a suppression phase. I pay attention not because central banks are infallible, because their motives are longer and more structural than the motives driving retail panic, and then there is silver. Silver is where this whole cycle gets even more interesting. A lot of people talk about silver as though it were simply cheaper gold. That is lazy thinking. Silver is not cheaper gold. Silver is a monetary metal with a second engine attached to it, industrial necessity. And that second engine matters much more now than it did in older cycles. The modern world is hungry for silver in ways previous decades never were. Solar panels, electric vehicles, high-performance electronics, defense systems, advanced infrastructure. Industrial silver demand does not care whether a commentator on television thinks the metal looks overbought. It cares about physical need that matters because the silver market is already tighter than most people understand. For years now, industrial demand has been eating more than mine supply can comfortably replace, and silver production is not as flexible as the public imagines. You cannot simply decide to conjure abundant new silver output because the price is higher. Much of silver comes as a byproduct. That means the response function is slow. A tight market with inelastic supply, growing strategic demand, and periodic monetary interest is a dangerous thing to stand in front of once the suppression phase ends. That is why silver can look dead at exactly the wrong moment and then become the fastest horse later in the cycle. It lags, confuses, punishes, and then explodes. That pattern is not an accident. It is the natural consequence of its hybrid role. Gold tends to lead the monetary recognition. Silver often lags the first move, absorbs the pain with even more drama, and then begins outrunning gold once the structural bid returns, and the industrial engine keeps pulling. That is why I always tell people not to confuse silver's short-term ugliness with silver's long-term uselessness. Silver is usually ugliest right before it becomes interesting. Now, I want to organize the entire sequence into something you can actually use, because if all I give you is a good story and no operating framework, then I am just another man talking into a microphone. This cycle has 4 phases, not because I enjoy tidy numbering, because markets like this really do move in distinct chapters. The first phase is the panic phase. This is the immediate aftermath of the shock. Oil spikes, gold may pop briefly. Silver may move too. Then the real mechanics take over. Yields stay elevated. The dollar strengthens. Paper selling accelerates. Retail becomes confused. This is the phase where the public buys the first headline and then gets punished by the second. The second phase is the absorption phase. This is where the initial panic has passed, but the suppression remains. The narrative is now ugly. The price action is worse than people expected. The media starts describing gold as a failed safe haven. Silver looks like a disaster. This is where the weak hands sell, not at the first spike. During the dull, humiliating, confidence-draining suppression that follows it, this is where people with no real framework start liquidating, and historically this is the zone where the long-term opportunity becomes most asymmetric because the mechanism is still real, but the marginal seller is becoming emotionally exhausted. The third phase is the structural bid phase. This is when the suppression starts losing force. The market is no longer being dominated by immediate oil shock arithmetic alone. The deeper questions begin taking over. How long can rates really stay this high? How sustainable is the debt burden? How long can the dollar remain this strong if the eventual policy answer involves rescue, accommodation, or debasement? How much gold are central banks still buying? How tight is silver? Really, this is where real money starts quietly moving back in. Not the tourist money, the structural money, the money with patience, the money that buys because the long-term arithmetic became more compelling during the suppression, not less. The fourth phase is the revaluation phase. This is when the move becomes obvious to everyone too late. Gold makes new highs, silver stops being mocked and starts being chased. The people who sold in phase 2 begin telling themselves they will buy the next pullback. The next pullback usually happens from levels much higher than where they sold. That is the cruelty of cycles like this. The market offers the gift when it feels like punishment and the reassurance when the easy money has already been taken. Now, based on the current structure, I think we are between phase 2 and phase 3. Not because I enjoy drama, because the ingredients are lining up that way. The initial forced selling has already done enormous damage. The public is demoralized. The paper market has expressed the mechanical suppression with force, and yet the deeper structural supports under gold and silver have not weakened. If anything, they have become stronger. Debt is worse. Policy flexibility is worse. Central bank buying remains elevated. Silver's physical story is tighter, not looser. That is not the profile of a broken thesis. That is the profile of a thesis moving through a suppression chamber. Those are different things. And if you cannot tell them apart, you are exactly the kind of investor the cycle is designed to harvest. Now let me tell you the only two indicators that really matter to me here. Not because they are magical, because they tell me whether the suppressive mechanism is losing control. The first is the dollar index. If the dollar remains very strong, gold remains under pressure for all the reasons we have already discussed. A very strong dollar means emergency demand for dollar assets is still dominating the short-term picture. The moment that begins weakening in a meaningful way, one of the biggest headwinds comes off the metal. I do not care what the war headlines say on any given afternoon. If the dollar is telling me the stress bid is still dominant. The second is the 10-year Treasury yield. As long as the yield remains materially elevated, the short-term opportunity cost logic stays alive. Once yields begin retreating in a serious way, the arithmetic flips. Suddenly, the same institutions that could justify rotating toward bonds begin facing a different landscape. The carry advantage weakens. The policy path looks different. The metal's relative case improves. Those are the two numbers I want on the wall. The dollar and the 10-year yield. Everything else is interesting. Those two are load-bearing because they tell you when the first phase, S logic, is ending and the later phase, S logic, is taking over. That is what matters. Not the daily emotional weather, the handoff between regimes. Now, if you are listening carefully, you may be asking the obvious question, what do I actually do? The first answer is what you do not do. You do not panic because the tape embarrassed you. That is the default response, and therefore the wrong response. You do not assume that because a correct long-term thesis has been painful in the short run. The thesis was false. That is the logic of children. You do not use leverage to express a long-term thesis through a short-term suppression cycle unless you enjoy being forcibly educated by the market. That is how promising ideas become personal disasters. You do not chase every daily move trying to recover your confidence. That is vanity disguised as activity. The second answer is harder. You decide what kind of owner you are. If you are the kind who needs constant emotional validation, this cycle will probably break you before it pays you. If you are the kind who can distinguish temporary suppression from structural invalidation, this cycle can become the most important opportunity of the next 5 years. That is not an overstatement. The magnitude of the current structural setup is extreme. Debt is worse than older cycles, silver supply. Demand balance is tighter than older cycles. Central bank reserve behavior is more supportive than older cycles. The Federal Reserve's clean escape routes are narrower than older cycles. That combination matters. It matters enormously This is one of those moments when the world can look discouraging right before it becomes lucrative. And if you do not understand the pattern, you will mistake the discouragement for the verdict. That is what most people do. I do not want you to do that. I want you to stop asking whether gold and silver are working this week and start asking which phase you are standing in. That is the question with teeth. That is the question that separates someone who survives the cycle from someone who gets harvested by it. Now, I want to say one more thing about institutions, because retail investors love to think the institutions are always smarter than they are. Not always. But institutions do have one advantage. They tend to understand sequence. They understand that a market can be structurally bullish and tactically painful at the same time. They understand that a temporary suppression does not invalidate a long-term target. They understand that a good trade can get cheaper before it gets right. That is why you see major research desks maintaining or even lifting long-term targets for gold while the public is staring at the short-term damage. It is not because they enjoy looking silly. It is because they are working on a different time horizon and a different mechanism map. They are not pricing today. Pain as if it were the whole story. They are pricing where the debt, the currency, the yield structure, and the reserve architecture are likely to push things once the suppressive chain runs its course. That is the posture I respect. Not because big banks are noble, because in this instance the logic is structurally sound. The final move is unthinkable only to people who have not studied the pattern. That is what I mean by unthinkable. Not magical, not impossible, unthinkable, because most investors cannot emotionally imagine a market they are being punished by today becoming the market that defines the next several years. But that is exactly how major cycles work. The greatest opportunities often arrive disguised as temporary failure. That disguise is the point. If the opportunity looked easy, it would already be priced out of existence. So here is the final choice. You can do what most people do in phase 2. You can look at the red, assume the logic failed, and liquidate the very position you originally built because of debt, debasement, geopolitical fracture, and distrust in the monetary system, all of which are still there. And in some cases, more extreme than before. Or you can do the harder thing. You can understand the mechanism. You can accept that oil shock suppression is a phase, not a verdict. You can watch the dollar. You can watch the 10-year. You can respect the paper selling without surrendering to it. You can understand that gold and silver do not need to behave perfectly in the first act to become the defining winners of the later acts. That is the adult posture, not hope, not fear, phase recognition. Because if you know the phase, you stop letting the market's temporary cruelty rewrite your long-term map. And right now, in my judgment, that may be the single most valuable thing a precious metals investor can understand.